Hey, Sarah. Yeah, those 13 Fs, while a lagging indicator for where managers are currently positioned for their long equity holdings, serving as a nice metaphor for how growth and value investors are trading this year. Now, it's clear that perhaps the most well-known value investor is finding new opportunities in this market. Berkshire Hathaway scooping up $3 billion worth of Citigroup, $2.6 billion of Paramount Global, and $1 billion of materials company Celanese. Berkshire did sell out of its stake in Verizon and much of its pharma exposure, dissolving stakes in AbbVie and Bristol-Myers Squibb and paring back Royalty Pharma by 83%. Selling was par for the course, though, for investors with overweight exposure to growth and tech. No surprise there, kind of mirroring what we saw in the markets. Tiger Global reducing a slew of its tech positions with one interesting exception. Square parent company Block, a stake the firm doubled during the quarter. Third Point selling tech as well. Dan Loeb's firm dissolving a stake in Alphabet and dumping almost its entire holding in Amazon and 2/3 of its Microsoft stake. Appaloosa was more idiosyncratic, a seller of Alphabet and Meta, but a buyer of Microsoft and Amazon. David Tepper's firm also bumped up its Uber stake during the quarter as well. But Baupost, another value-oriented firm, was a buyer of tech, at least of big tech, in the first quarter. Seth Klarman's firm bumped up its holdings of Alphabet and Dropbox while selling just a small fraction of its Meta stake. Now, all 13F positions are as of the end of March. Many have likely changed since then. These filings show long equity positions in certain options exposure. They don't detail shorts or other asset classes, guys.
Yeah, Leslie, even with the lag, in fact, it's kind of interesting when it comes to a lot of the movements around the tech names, specifically Tiger Global, because we did hear last week a lot about how that firm, even through April, was having tough performance. And it just seemed as if there was an overhang on the NASDAQ, this sense that there was a lot of, sort of money that was being squeezed, these funds that maybe were forced or quasi-forced sellers. I guess the overall picture that emerges from these filings is the positioning seems to have really lightened up quite a bit in terms of the big growth names.
Mm-hmm. Yeah, I think that's a really good point, Mike. And of course, we look at a decent sample size here, and we're still kind of parsing through a broader sample size of filings to really extrapolate. But it is a good question, since there was so much selling in the first quarter. How much selling is there to go? And how, when you kind of look at the different types of managers and what their portfolio is comprised of at this time, how many of the people are buyers? I think it is interesting that you see value investors dipping their toes into tech, and you see, some of the more growth-oriented firms really selling out their portfolios. Potentially in the upcoming quarters, they'll be looking at non-tech names, perhaps, to kind of shift their portfolio for the current environment, Sarah.